to start recording and share my screen. Let's rewind you what we have discussed yesterday. So yesterday we have discussed about the different methods in depreciation and then how we can configure the depreciation profiles in Dynamics. After that we have discussed about fixed asset groups. What are the different types of fixed assets and how we can group fixed assets actually. And we have created one fixed asset group and seen the various options available in the fixed asset group. And before to that, we also discussed about what are the different types of fixed assets, what are fixed assets and different types of fixed assets in business normally, and how each are valued usually. We have seen them like intangible and intangible assets. Today we'll go to the other topic. So fixed asset groups we have created right yesterday. We have created one group like vehicles and we have created two groups, I guess. So it's in fixed assets. So depreciation profiles are normally here and fixed asset groups are here. So you can click on fixed asset groups. We have created two groups yesterday. This one, furniture and fixtures and vehicles, two groups, right? So we have given unique number sequence for that. I just want to delete this capitalization threshold. I don't want to use it, but furniture and fixtures, I have this here. So we'll continue with these two groups. There can be many groups, as you can say, at least 10, 5 to 10 groups they'll create depending upon the requirement or the number of assets they possess or how they categorize the assets in Dynamics. So they have they have various options. Then we are going to discuss about one very important concept today called as books. Okay. Books in fixed assets is a very important concept and a compulsory interview question. They will ask you in interview what is a book in fixed assets or what is the use of books in fixed assets. Okay. One second. So yeah, books are how to define this definition. I can define many ways. The character of a fixed asset is defined in books. Character in the sense you can say behavior, or you can just say the behavior of a fixed asset. Of a fixed asset is defined in books normally. Behavior in the sense how it has to, how much value it have and how it has to be depreciated. All the details are actually given in books. So to say all the details that are required for a fixed asset, I mean the date of acquisition, the fixed asset on the amount of acquisition, and then depreciation profile and any other alternative depreciation profile and the way how it was bought for and the scrap value or the salvage value of the fixed asset. So all these details are normally in books. Or books is a mechanism which controls a fixed asset, however controls the behavior of fixed asset. You can say in this way, books is a mechanism controls the behavior of fixed asset, behavior of a fixed asset, contains the details like acquisition amount, asset status, acquisition amount, acquisition date, depreciation profiles. So Scrap value, etc. You can say in this way. So you can in interview you can say this one: books is a mechanism that controls the behavior of a fixed asset. It controls the details like asset. It contains the details like asset status. What is the status of the fixed asset, acquisition amount, acquisition date, depreciation profiles, and scrap, etc. Okay. So normally we will link the books to fixed assets. You can create many books if you want to. So you can create different types of books if for a single fixed asset also. If you want to maintain a single fixed asset, suppose on the basis of two methods, like Companies Act as well as Tax Act. So both of them are different again, are according to the local GAAP and according to the IFRS GAAP. Let's assume two examples. So suppose that the parent company of the parent company or the main company of this particular organization is located somewhere in US, which normally follow US GAAP principles. Okay, the subsidiary companies are located in India, which usually follow the IFRS GAAP principles. Let's assume. Okay, according to IFRS GAAP, so the depreciation calculation is slightly different, and according to the US GAAP, the depreciation methods they follow are different. So maybe to be parallel to the US GAAP pattern that for fixed assets, so we might create another book for US for the representation of the fixed assets in according to the US GAAP also. So you can maintain a single fixed asset in multiple ways using different books. So if you have 4 books for fixed assets, you can give 4 different acquisition values, you can give 4 different depreciation profiles, and you can maintain a single fixed asset in multiple ways. Normally the acquisition value will be the same in every book because the asset will be bought for the same value, right? But the depreciation will change. So in normally in Companies Act book, we use depreciation according to the straight line life remaining method or service life method. Coming to the Tax Act book, we use reducing balance method. So we can follow any method. Let's see how it works. Okay, and how depreciation will be calculated using two different methods. So here I am creating two books, CA book means Companies Act book and TA book, Tax Act book. Okay, I'll create these two books and I'll give different layers for these two books and I'll explain you further how it works, each book. Okay, this is the brief description about books, and if once you try to understand the configuration and the logic of how the books work, so you will get a justification for this definition, or you can frame your own definition in that case too. Let's see how we can configure the books in Dynamics. So for that you have to navigate to fixed asset module again, and here you can see setup. Under setup I can see books here. Fixed assets, setup and books. So let me click on books. See, I don't have any books here. I'll create one. I'll create two actually. I'll give the book name CA book. I'll write it as Companies Act. So Companies Act book. So it won't be the same name. The names will vary. I mean, the client might require another code or another name. So you can configure it according to the client, or you may suggest a better name other than this if you want to. Okay, CA book or MRF CA you can give, MRF CA book you can give. It's up to you. Then here you have few options. As you can see, calculate depreciation. Using this particular book, do you want to calculate depreciation? Yes, I want to calculate depreciation because the whole purpose of giving this book is to calculate depreciation. Then what is the depreciation profile that you want to use in the book? Okay, if you give a depreciation profile here, suppose I'm giving this straight line service life method. Okay, straight line service life method I'm giving as book here. You can see it. So if I give a book here, if I give a depreciation profile here for the book, so I can link this book to any fixed asset that I create. If I link this book to any fixed asset that I create, by default, this depreciation profile will be taken into that asset, or for that asset, this depreciation profile will be taken. Or you can override it there itself if you want to, or sometimes you can leave it blank here. whenever the book is assigned, you can assign it manually the depreciation profile there. Okay, it's a good practice that you will assign it in the book, because according to Companies Act, you will always have straight line service life only or straight line life remaining. So you will select one straight line service life here. You can also maintain alternative depreciation profile for your fixed asset. See, you can maintain one depreciation and two depreciation profiles also. The third one is for extraordinary depreciation. In the extraordinary depreciation, you can only give manual. Other than manual, you can't give anything. If you give anything, it will not allow. Extraordinary depreciation is allowed only for depreciation method manual. So this extraordinary depreciation is usually for those situations where asset gets damaged. Like yesterday I told you, right? Natural calamities or any disasters or accidents happen in business, which would eventually damage the assets of the fixed assets of the business. So we can use this extraordinary depreciation profile to depreciate a more amount according to that particular damage that is faced by the fixed asset. So we can deduct that amount as an extraordinary depreciation. So we have that process. So you can give that manual method here. Other than manual, it won't consider anything. You can define your own manual method, how much percent of depreciation has to be depreciated on the fixed asset, and you can do it. Or you can also manually do it. If you want to depreciate a fixed asset, you can manually reduce a large amount from the asset rather than using a profile. But using extraordinary depreciation, if you reduce the balance, so it will be in a record that this asset have undergone through some extraordinary situations like accidents or calamities, so because of which it is damaged, and that depreciation was reduced here using this extraordinary depreciation profile. That's all. So alternative depreciation profile is I have one here. So I'll show you why how this works. Actually, you can give a different depreciation profile here, like 125% method, reducing balance 125. We must have the same depreciation year and period. Okay, this is for yearly we have taken, right? So that's why it is showing. So normally I'll take anything else like monthly, water monthly we have. So we don't have any monthly depreciation. Or let me go to view details. So 125 we give it as calendar and yearly, right? So every year I'll have 125. So I'll just change the period frequency to monthly. That's okay. Now I'll go back. So let me give this 125 here, reducing 125. Okay. So now here I gave two depreciation profiles to a fixed asset or in this particular book. And if this book is assigned to a fixed asset, suppose fixed asset depreciation is calculated in two ways, in according to this profile and according to this profile. So in which profile highest depreciation is calculated, that will be considered for the depreciation of that month. Suppose in straight line service life, depreciation calculated for the month of November or the end of November is 1000. Under reducing balance method, it is 1500 suppose. So system will consider whatever is the highest amount. So 1500 will be considered as the depreciation amount for that particular month. Okay, you can maintain two profiles also for an asset, but normally they don't maintain. There is a feasibility to maintain. In US, they maintain normally two different depreciation methods, but in India, they maintain only one method, straight line service life. Straight method, so only one. So you can also give two. I'll just give two here to show you as an example while I create it. Okay, these are the three depreciation profiles we can give. This extraordinary depreciation will not come into picture until and unless you run the extraordinary depreciation for the fixed asset. Okay, if you want to do it, you can do it using this method. Then round off depreciation, to which number you want to round off depreciation, net 10 cents, like you can say. Leave net book value at. Leave net book value at means, so without depreciating the net book asset, how much net book value should be left over? Or if I say leave net book value at 1000, an asset value of 1000 will be left over without depreciating, or you can rightly call it as the salvage value. Normally you may not give it here in the book, but depending on the each fixed asset, you can give scrap value separately, so that depreciation won't be calculated on that value of the asset. So here 1000 will be taken or kept aside without calculating depreciation. On the remaining amount of the remaining acquisition amount of the asset, depreciation will be calculated. Okay, I'm leaving it as 0, but for each fixed asset that I create, I'll give some scrap value and I'll show you. Create depreciation adjustment with basis adjustments. So this is a situation where, in case if you are if let's assume that you have acquired a fixed asset on 1st of January and you have depreciated until December 31st, 2021. 12 months you have depreciated the fixed asset. Let's assume that we are in at the end of December and we have depreciated it. We have forgot to post an acquisition adjustment entry or an increase in the acquisition value of the asset in the month of June. So we have to add it in the month of June actually, but we forgot to add it. So now we are going to add it in the month of June. Suppose in that case, depreciation has to be calculated on the amount that you add, right? So suppose if I go with the example here, asset is acquired on Jan 1st. Okay, so Jan 1st for 10,000, let's assume. And every month there is a depreciation. So 12 months, right? Every month there is a depreciation of, where is this? Into, okay. There is a depreciation of 500, let's assume. So total of 6,000 is depreciated. So 500 in the sense it is like how much percent here? 2.5% is 10% is 1,000. So for 5%, right? 5% is 500. So 5% is depreciated every month. Let's assume 500, 12 into 500, 6,000 is deducted by for 12 months. But we forgot to post an acquisition adjustment entry or addition of acquisition, which is done on 1st of June, suppose, or 1st of July, let's assume. 6 months were done, and in the 1st of July, we have added another 2,000 to this particular fixed asset. Okay, 2,000, right? But this 2,000 we are trying to post on the end of December. We forgot to post it for the 1st of July then, but today we are going to post it for the date of July only, but we are posting on the December end. Here depreciation has to be calculated on this 2,000 also for the 6 months, because you should have acquired it on 1st of July, or acquisition adjustment, additional acquisition, I would say. Additional acquisition of another 2,000. So depreciation has to be calculated on this 2,000 also for 5% for the 6 months, or reduced from the asset for 5%. So 5% on 2,000 means it will be like 100, right? Yeah, 100 has to be reduced for another 6 months, like here. 6 into 100, another 600 would have been reduced. 5%. Yeah, it is 100. So 600 should have been reduced. But because you are posting it late, if you had posted it on the 1st of July, when you run the depreciation for 31st of July, normally it would calculate depreciation of 500 plus 100, 500 on this 10,000 and 100 on this 2,000 additional that you have acquired. So it should calculate 600 depreciation for the month of July, August, September, and another 6 months. But since you forgot to post this one, or post the acquisition adjustment earlier, so you have missed the calculation of depreciation of 5% for 6 months. So like 100 for 6 months, 600. So if you are posting an acquisition adjustment entry today at the end of the year, depreciation adjustment entry also will be posted automatically. So that will be posted only when you enable this parameter, create depreciation adjustment with basis adjustments. If you make any changes in the base value of the asset or the acquisition value of the asset, then depreciation adjustments also has to be considered. So if you enable this parameter, system automatically create those depreciation adjustments. If you disable this parameter, it won't automatically calculate. You might have to manually adjust the leftover depreciation for the acquisition adjustment that you have acquired, like for this 2,000 that you have acquired, 600 is the depreciation calculated for 6 months, right? That you have to manually adjust. But if you enable this parameter, it will automatically adjust. So I will enable this one just to show you as an example. Post to general ledger. Yeah, we will post to general ledger because Companies Act book is the main book we maintain. So for this, we are giving current layer here. As you can see, current layer is the main layer, right? We know. So post to general ledger means every transaction that I record using this book will be posted to general ledger. Will be definitely posted to general ledger and posted to current layer. Current layer means the main layer in which normally all our accounts are recorded is the current layer. So we will use current layer. We have different layers also, but for Tax Act book, we'll use tax layer. I'll show you how we use it. So for here, I'm selecting current layer. So allow net book value higher than acquisition cost. You can allow it, which means like I am buying an asset for suppose 10,000, right? Suppose if my acquisition adjustment is making this acquisition value as 15,000 or adding more value to this asset, suppose. So can that be allowed or not? It is what it is saying. Allow net book value higher than the acquisition cost means after all, after depreciating, suppose let's assume that the asset was acquired for 10,000 and after depreciating for 2-3 months, the asset net book value. So a reduction of depreciation minus from the acquisition value is like 8,000. Net book value is 8,000. Now, if I'm making any adjustments or acquiring some more value on the asset or adding some value to the asset like acquisition adjustment of another 4,000. Now the asset net book value will suddenly become 8,000 plus 4,000, 12,000, which is more than the actual acquisition value. So can I acquire in this way or can I make such adjustments which would increase the net book value of the asset more than the initial acquisition value? That's what the parameter is for. Allow net book value higher than acquisition cost. So I want it higher than acquisition cost. I can allow it. If I don't want such adjustments which would increase the asset value more than what it is looking like. So if it is 8,000 here, if I'm making 1,500 acquisition adjustment or adding 1,500 to the asset again, so the net book value will become 8,000 plus 1,500. So 9,500, which will be less than the acquisition of acquired value of the asset. But if it is like 4,000, then it will be 12,000 total value or net book value, which will be eventually more than the acquired value of the fixed asset. So if you want to allow it, you can allow this parameter. Mostly it will be enabled or disabled required on the requirement of the client. Normally, if at all there are frequent acquisition adjustments that are done in the business on the fixed asset, so you can keep it as yes, better. Allow negative book value on fixed asset. Do you want to allow the net book value of the fixed asset to become negative? So mostly there won't be any negative value on the fixed assets. Either it will be a positive value or zero. Net book value will never become negative. Okay, how much ever loss you face on the fixed asset, but it doesn't really become negative. It will become zero if you face total loss, right? But if you want to allow it to be negative, you can allow it. But I don't want to allow it to be negative. I'm not allowing it anyway. So here is a situation where you can assign your own calendar to the book. So this is parallel to the depreciation profile that you have selected. See, in the depreciation profile, you have selected calendar right here. So this means it will normally select the January to December calendar. Otherwise, if you would have selected any fiscal calendar other than normal calendar here, suppose. So then that fiscal calendar you select here will be taken from here. So you can give that fiscal calendar here. So I told you initially while I was creating calendars that you can create a separate calendar for fixed assets. So you can follow one fiscal calendar as you wish, but for fixed asset management, you can create a different calendar only for the fixed asset depreciation, generation and calculation and posting. So you can give any calendar here, a separate calendar you can create for fixed assets, or you can use your own fiscal calendar like MRF. What you have MRF calendar, you can use it also. But I'm not giving this calendar because I want to follow the same January to December pattern, which I have given in the depreciation profiles already, calendar and monthly, not this calendar according to the fiscal calendar. If you want it according to the fiscal calendar, you would have selected the option in the depreciation profile as fiscal calendar, and then you can select what calendar you want here. So you can select the list from calendar from the list of calendars you have, or you can structurize or create a separate calendar in the fiscal calendars. Initially, we have done it in the general ledger module. From there, you can create one for your fixed asset management and you can assign it here. So that this book will always consider this fiscal calendar or the periods in this fiscal calendar that you assign here for the calculation of depreciation. Okay, so that's one. And I have this option derived books. I'll tell you what it is. So this is for current book, how I can create a current book. Now I'll create another book called as Tax Act book. So just follow this one, Tax Act book. So you can give the same actually. Tax Act book Calculate depreciation. Yes, I want to calculate. Which method you want to use? I want to use reducing 30% method here. So I'm not using straight line service life here. Straight line service life is for Companies Act. Reducing balance is for Tax Act. So I'm using Tax Act book here. If you want alternative depreciation profile, you can use it. If you don't want, just leave it. Extraordinary also optional. You can keep this one as manual. You can anytime change all these things, but not mostly they will change. Once the depreciation profile is assigned, they don't want to change it often. Extraordinary depreciation profile, you can change anytime, no problem with it. Then depreciation round off, I'll give the same 10 cents. Leave net book value at, I'm not giving anything. Create depreciation adjustments, okay. Post to general ledger, okay. But post to not to current layer. Be very cautious about this one. For Companies Act or for one book only, you will post to current layer. For the remaining books, you will not post to current layer. Okay, remember that. For the other books, you will post into different layers. For Tax Act book, you are posting into tax layer. If you would create any other book, you can post it into a different layer also. Or you can use this option, post to general ledger as disabled. What happens if you disable this option is, it won't hit any main accounts. It won't have any vouchers when you post any transactions to fixed asset. It will just post transactions to the fixed assets or balances to the fixed asset. That's all. Acquisition balance, depreciation balance, revaluation balance, or sale balance. It will just post the balances to the fixed asset only. It won't affect any main accounts behind the fixed asset if you disable this option. You can also create such dummy books or another book which you don't want to post into general ledger, so that for that particular fixed asset, again the same fixed asset can be maintained in a different way using another book. Okay, if somebody asks why you maintain different books for fixed asset, you can say that if you want to maintain a fixed asset in multiple ways, a single fixed asset in multiple ways, maybe according to the different acts in the country, or maybe according to the different gaps followed. So you can use different books or differentiate different books, and you can maintain a single fixed asset in different books. And you can use different depreciation profiles in each book, so that depreciation calculated on the fixed asset will differ from one book to another book. But one main book will be posted to current layer, but other books are posted to other layers like tax layer or none layer also you can have. I think here it's not seen up, but there is another layer called as none also. You can also give that one. Or if you say not post to general ledger, it will automatically take none here actually. You can see. Means it will not post to general ledger. Any accounting impacts will not be done if you not post to general ledger. If you post, yes, you can see, but you will have to give another layer, not the current layer. If you give current layer again for two books, two times you will see the effect for balances for the main accounts, which is wrong. Should not do that. You can give one book and you can give another book. And if you want to maintain different books, you can give other layers also. Custom layer 1, custom layer 2, 3. You can use all these layers, additional layers if you want to maintain more books other than this. If you want another 4 or 5 books, you can use these layers for each book separately, so that balances will be represented into different books separately. So understanding this logic is important, guys. Let me know if you have any confusion in this one. Posting layer, anyone. So Companies Act, it is current book. Tax Act, it is tax book. What's issue?
Can you come again once regarding posting layer?
Posting layer. So normally all the transactions until now, what all we have posted were posted to current layer only, or will be posted to current layer only, because it is the default and main layer. Okay. But for this particular fixed asset that we are creating, we want to maintain the same fixed asset in two different ways. We have to post the acquisition entry in 2 times. One in current book and another one in Companies Act book and another one in Tax Act book. Okay. But if I post it 2 times, both of them to current layer, it will affect 2 times, or the ledger accounts will be affected with 2 times. So I don't want the ledger accounts in the current book to be affected 2 times. I want it to be affected only 1 time. When an asset is acquired, asset account will get debited and the cash account will get credited, or cash account place we will get retained earnings account, or any other vendor account will get credited eventually. So this is for once. Again, when I post the same acquisition entry in the Tax Act book, It will affect the accounts, but it will affect in a different layer, Tax Act layer. It will not affect the main layer. So the balances in the main layer for the trial balance will be remaining safe without any effect. If you post a second entry also, or if you acquire a book, if you acquire a fixed asset second time also, I mean not second time, into a different book actually. So I'll show you that relation, how it looks like further. I mean how this link of books works. So for the tax book, I gave a different layer here as tax layer, so that balances will be posted to tax layer. So if you want that to understand, normally I can show you. So every journal that we create in journal names, for every journal we have a layer option. See here, we have a layer option called as current layer here. For every journal we gave current layer. For this one we gave current layer. Whenever we created journal we gave current layer. Invoice journal I gave current layer. Revenue I gave current layer. Okay, which means all the transactions that we post using these journals will be posted to current layer by default. Okay, current layer is the default layer. And when I go to general ledger for trial balance inquiry, see here you can differentiate your balances according to the layer. So if I click on calculate balances, it is for current layer, as you can see. So these are the balances in the main accounts according to the current layer. But if I run the same for tax layer, suppose here I am selecting tax layer. The same main accounts will be there, but balances will be different. So it's a separate representation. See here, there are no balances posted into tax layer at 0. So that is why I can see all of them as empty. But for the same main account, I can post some balances in the tax layer also. Same cash account, same rent account, anything. But that will not be affected to the current layer. The representation of balance in the current layer is different to tax layer, and to any other layer it is different. It will not overlap the balances or double impact any balances if you post it in a different layer. So for current, again, I have these balances. So these are all the balances or debits and credits done in current layer, which is the main layer. So for tax layer and other custom layers or dummy layers, you can use them for representation of the balances. Just, I mean, for the sake of dual representation of a fixed asset, that's all. Got some ideas, Seshu?
SJP.
Okay. Going further, we'll post two transactions. I mean, in the Companies Act as well as in the Tax Act, and we'll see how both of them will work or how they will be represented in the trial balance. Okay. Then these are the two books I have created, and the next concept I have is derived books, which is most important. Or I mean, in interview they will ask you this question logically: what is derived books? So in derived books, actually, I can keep a link from one book to another book. Suppose if I am posting a acquisition transaction in Companies Act book, and if I want the same acquisition transaction to be posted in the tax book automatically, then I can link both the books. Suppose here in the Companies Act book, under derived books, I will link the Tax Act book and give the transaction type as acquisition. Let's assume if I am using Companies Act book and posting a acquisition transaction for a particular fixed asset, automatically that acquisition transaction will also be posted in the Tax Act as well, or the tax layer as well, because you have given a link here as derived book. In the same way for other transaction types also you can give. There are a lot of transaction types for a fixed asset, like depreciations, depreciation adjustments, revaluations, write-ups, write-downs, net book value, profit and loss. We have a lot of them, but the majorly used are acquisition and acquisition adjustment only. So I'm linking here and acquisition adjustments. So you have linked it in the Companies Act book, which means whenever you are doing any transactions in the Companies Act book, like acquisition or acquisition adjustment, it will be posted to tax layer. But if you do anything in the tax layer, it will not get posted in the Companies Act book. Or if you do anything in the Tax Act book, it will not post it in the Companies Act book. If you want that to happen again, you can link it here. Companies Act book can be linked here. Both the books can be linked in opposite way. In this way. Depreciation I am not linking because Acquisition value will be same here and here so that I can link both of them. Whenever I post an acquisition transaction here, automatically it will post it in the tax book also. Two different transactions will be posted, one for current layer in the Companies Act book and one for tax layer in the Tax Act book. But depreciation I can't post for the same amount, right? Depreciation valuation in Companies Act book is for straight line service life method or according to straight line service life method, which will have a different value. In the Tax Act book, I have reducing balance method, which will have another different value, not the same as Companies Act. So I'm not linking the depreciation transactions here. I'll post that depreciation transaction separately for Companies Act book and Tax Act book. I don't want to combine both of them for the depreciation because depreciation calculation will not be the same on both the books because we have given different depreciation profiles in both the books, right? So that's the reason. So that's how we can create books and give different link to books. So you can give, if you want to give for sale of the fixed assets, if you want to link it, you can link it here, like select the Tax Act book. And for the sale of fixed assets, you can give disposal sale here. So you can link the sale. Whenever you sell it in the Companies Act book, automatically the sales entry will be posted in Tax Act book also. But for the entries to be posted, we have to configure one more thing, which is called as posting profile. So we will configure that in the next class, in the next part of the class. So this is how we can create books and derived books. So I'll just save it. You can link books to fixed asset groups, or directly you can link fixed asset groups to books also. Anything can be possible. Here from books, you can click on fixed asset groups. Normally it will show you the list of groups that are related to this particular fixed asset book, but I'm not linking any group here. What I'll do is I'll go back to fixed asset groups, and for each group I link the books directly from here. I have the option. See, vehicles group and for furniture and fittings group, I have fixed asset groups. So for vehicles group, I will go to books and I'll link that book. I'll just click on new or edit this one, which I have already. So I'll give Companies Act book here. If I give Companies Act book, it takes the current layer here, as you can see. So you can give the service life of the fixed asset if you want to. For vehicles, so normally the service life will be for 10 years, suppose, or 5 years. Let's assume only 5 years. So service life of 5 years. Once I gave 5 years, automatically it is showing us 60 periods here. Why? Any idea? Depreciation periods, it is showing us 60.
Five into 12.
Yeah.
And we given calendar.
Calendar, and we have given it as monthly calculation, right? So for 5 years of life, it is for 5 into 12, 60 periods of depreciation. It will calculate from the date of acquisition of fixed asset. It will calculate depreciation for 60 months because the life of the asset is 5 years. That's how. Depreciation convention is a topic we will discuss in the further class. So how depreciation will be calculated in the first month, first year of the acquisition of fixed asset. If at all we acquire the fixed asset in the middle of the month or middle of the year. So we will discuss this topic once we create a fixed asset. Okay. Then I see these depreciation profiles are automatically showing up. You can see straight line service life method, calendar and monthly. Alternative depreciation profile reducing 125, calendar and monthly, extraordinary depreciation profile, manual, calendar and yearly. So these are automatically reflecting from the book that I have created. I can also add the other book, Tax Act book, here to the same fixed asset group. So Tax Act book, here also I can give the same service life as 5. Okay, and I can save this. For this, I did not give any alternative depreciation profile, which intentionally I removed it. So this is how I can link the two books to the fixed asset group that I have created. Okay. So now I can refresh this, and in the vehicle I can see posting layers as current comma tax, means both current layer book is there as well as the tax layer book is also there. So two books are there in the vehicles group. So for the furniture and fixtures also, I'll link the book. Here I'm going to books. So this one is there, empty one. So I'll link it Companies Act book first. Furniture and fixtures also I'll give service life as 5, or I can give it as 3 years only. Like 3 years means 3 into 12, 36 months only will be the depreciation, or 36 depreciation periods I'll have from the date of acquisition of the fixed asset. So I can also link the other book, Tax Act book. So when I link it, I can see the tax layer here. For this also I can give 3 years. So if I give 3 years, it is showing 3 years here, because reducing balance is normally 30% of reducing balance is calculated for yearly basis. So that is why I see 3 year. So it is on a yearly basis. You can change it to monthly basis if you want to, and save it. And if you go back and refresh it, so normally if I remove this and again give 3, I can give 36 now. So that's how. So you can see 30% reducing balance calendar monthly. And if I go back, I can see refresh it, and I can see for furniture and fixtures also I can see both current and tax layer. So in the fixed asset group, I have linked the books to fixed asset groups. It's not compulsory that you have to link the groups to fixed assets, but whenever you create an asset, automatically these books will reflect onto the fixed asset group. So normally you will create a fixed asset and you will link this group to that fixed asset, right? So automatically the books that are there in this group, like we have linked 2 books, right? So that will be applicable to that fixed asset that you create automatically. If you don't link here, there you might have to give it manually for the asset. When you create the asset, you have to manually add the book for the asset. So that's a situation. I'll show you that one as well while I create a fixed asset further. So this is how we can create fixed asset groups and books. So next we'll discuss about the other concept called as fixed asset posting profile. So fixed asset posting profiles are like any other posting profile where we can link main accounts for the fixed asset transactions. For the various fixed asset transactions, we can give different types of accounts. Okay, before giving different types of accounts, I just want to explain you the entries that we normally get when we buy a fixed asset, depreciate a fixed asset, like that. Okay, if this is clear until here, the books concept for all of you, we can discuss about that one. If not, let me know if you have any doubts in this books concept yet, or if you want me to explain again, I can explain it, but this is a very important concept. So you got an idea, right? Why we create 2 books or multiple books? All of you?
Yes.
Santosh.
So it is for
Yes, bro.
any different acts.
Yes, here it is for 2
Legal
different acts. Yes, it depends
Acts in.
again.
Okay.
Please, Sai Chipun. Tell Sai. Hello.
Nothing, JP. Nothing, JP.
Okay. Normally in India, we maintain Companies Act and Tax Act, or we can maintain a fixed asset in according to Companies Act and Tax Act. Single fixed asset can be maintained in 2 different ways. For Companies Act, we will represent the balances posted in the current layer, the main layer. That is what we do, right? Normally in auditing, or to legally publish the balances, we will maintain the current layer balances. We will publish to the stakeholders, or we will to the auditors. But Tax Act balances, we normally show it to the tax authority when we declare our capital assets, how much the capital assets are there. So that we will represent to the tax authority according to the tax book. So in tax book, the balances will slightly differ from the Companies Act book. That we will normally represent to the tax authority, saying that, see, we have acquired asset on so and so date. We have depreciated according to the Tax Act, like 30% reducing balance every month. So we have this much of ending balance of the net book value of the fixed assets we hold. So that's what you represent to the Tax Act or the tax authorities. But for Companies Act authorities, you will have the normal balances that you post on regular basis, or the main impacts of the assets. That according to the Companies Act, you have a depreciation profile, and the ups and downs of the depreciations calculated will be represented in the Companies Act. Okay. So normally for the tax people, you only see the show the tax reports or the balance of fixed assets according to the tax book. For all the fixed assets, you have both the books, Companies Act book and Tax Act book. For tax authorities, you only show Tax Act books balances, not the Companies Act book balances, because Tax Act want you to reduce your depreciation in this manner, whereas Companies Act want you to reduce your depreciation in this manner. So to satisfy both of them, we use two different books to maintain a single fixed asset, and the transactions are posted into two different layers, not to get overlapped or double impacts, as to regulate the double impacts of the transactions.
But the depreciated values will be different, right? In
Yeah,
both
it will
the
be
books,
different.
we maintain different depreciation
Depreciation
methods.
profiles. Correct. That's the whole agenda of having two different books, to maintain two
Yeah.
different depreciation profiles and calculate depreciation in two different ways according to the two different acts. Okay.
JP, on the doubt.
Yes, Sai, please.
We are giving depreciation profile and alternative depreciation profile, right?
Okay.
In either of the two, only one will be posted.
Yeah, in either of the two, in which particular method depreciation calculated is higher. So according to that method, system will take that depreciation value for that month.
Can we look those values?
Yes, we can look that. Once we
Okay.
create a fixed asset, we can check them before we run the depreciation. I'll
Okay.
show you.
Okay.
Any other doubts, guys, in this? So here we have Companies Act and Tax Act. There are other countries where they maintain US GAAP book and a local GAAP book, or IFRS GAAP book and local GAAP book. They can maintain according to the GAAPs also, generally accepted accounting principles. Or they can maintain third book, fourth book also, their wish, and they can give another layer like custom layer 1, custom layer 2, or they can say that not post to general ledger, so it won't post and it don't take any layer at all because it won't affect any balances, right? So there won't be any layer at all normally. That's the logic. Now let us discuss about the entries that we get during the fixed asset acquisition and depreciation. So accordingly, we'll configure the posting profiles. Okay, normally, what is the entry for acquisition of a fixed asset? When we buy a fixed asset, what will be the entry? Anyone?
Asset to vendor or asset to cash?
When we buy a fixed asset, the fixed asset account will get debited or credited?
Debited.
Debited. Fixed asset account will be debited. So cash account will be credited, or if you are buying it on credit, vendor account will get credited. Right? If you are buying for cash, cash account will get created or vendor account will get credited if you are buying it from a vendor. So this will be the acquisition entry. Clear, right, for all of you?
Yes.
Santosh, Sushila, is it clear for all of you? I mean, this entry, acquisition entry.
Yeah.
Yes.
Okay, this offset account will vary. May it be a cash account or vendor account or any reserves account if you maintain any reserves, or bank account if you want to buy it through bank account. So it can be anything. Again, we have another one. So I'll just take these entries down. Depreciation. So when we depreciate a fixed asset, what will be the accounts that I'll get here?
Depreciation account debit to depreciation reserve.
So depreciation expense account will get debited. Since we are reducing the balance of the fixed asset, it is an expense. So depreciation expense will get debited. So what will be the credit?
Accumulated depreciation account.
Correct, we use accumulated depreciation account. Why not fixed asset account? We are reducing the balance from fixed asset only, right? So why can't we take it off from the fixed asset itself, like fixed asset as credit?
We can show the asset at its purchased value in the books of accounts.
Yes,
in
correct.
Reports.
So for representing the asset at the same purchased value, suppose if I purchase this asset at 10,000, so to show the asset value at the same purchased value, we don't normally use the asset account for credit in the depreciation here. So if the depreciation for the first month is like 100, so we don't reduce the fixed asset directly for 100 here, which means it will become 9,900. So we won't do it normally, but we will do it in another way. Like you will use another account here called as accumulated depreciation account. So that will be created for 1000. So instead of asset account or the same fixed asset account, we will use this accumulated depreciation account as a representative account for the asset normally. So in balance sheet, when you see fixed asset value will be 10,000. Under the fixed asset value only, you will have accumulated depreciation account. So it is a asset account only. We'll create it as an asset account, but it will always show negative balance. Credit means minus 100, right? It will show minus 100. So in the balance sheet, when you see the total assets, it will be fixed assets 10,000 minus the depreciation that you calculated or posted to accumulated depreciation as 100. So it will be like 9,900 in the balance sheet. Okay, anyway, this instead of reducing this asset value straightly, we will create another asset as accumulated depreciation and we will reduce it with 100. You can create it as an asset or liability, but mostly they'll create it as an asset to represent it on the asset side underneath the fixed asset account. So they'll show it as a negative balance of asset normally. Correct, Sai?
It will be shown in liability side, right?
It can be shown on liability side, but if I'm showing on the asset side with negative balance, then it is
Oh,
eventually
yes,
a
yes.
kind of liability only, right?
It has the same effect.
Yeah, that's what. So you can create as a liability or asset according to the practice of the business. So this is how it is posted for the depreciation. Again, for the sale and scrap, we'll see later part. So these are the major two entries that we have, or the transaction that we do with the business. So other than this, we have something called as write up and write down also. Write up of asset. Write up of the asset means it will increase the asset value, or normally will increase the asset value. When you write up the asset, so what will be the account that will get debited? Again, the fixed asset account only will get debited. If you write up the asset, fixed asset account will get debited for another 2000 if suppose. Okay, and you can use the write up reserve account, if write up reserve account for credit purpose if you are using to write up the asset. Or there is also another entry called as acquisition adjustment, right? So acquisition adjustment means adjustment to the acquisition value. May it be a increase or decrease. Suppose let's say increase only. Majorly it will be increase to the asset. Acquisition adjustment means suppose if I am buying a car here for 10,000, tomorrow I have installed some music system in the car. It is an acquisition adjustment to the car. I have also installed some this bumpers and all security system to the car. So side bumpers and front bumpers and painting, everything I have installed upon the car. So that costed me another 1,000. So that I can count it as acquisition adjustment. On the same fixed asset, I will add another 1,000 value because I have made some adjustments to the same fixed asset, and which is increasing the value of the fixed asset because of that repairs or that installation that I have done on the existing fixed asset. So if that is increasing the asset value, then I will add the same value to the fixed asset. So it will be debited here. Acquisition adjustment. Then I can take the cash. I mean, you can make the cash or vendor or anything for the acquisition adjustment. Also, you can use any alternative account. So it will be credited for 1,000. So these are the few entries we have. Clear this entries for all of you. Any confusion in this accounting entries? Let me know if you have any confusion. I can explain you clearly, no problem. Once again, Sairam, Sushila.
That write up asset
Write up
reserve.
asset. Write up reserves. Actually, we can use this write up and write down options in different situations in business. I'm not sure in which situation they use, but write up and write down can be done on a fixed asset value. So write down also will be there. Write down of asset, which it will increase the fixed asset value. Write up means fixed asset account will be debited, and that credit value will be taken from the reserve account. Normally, you will maintain or you can record it as a reserve account. Write up reserve. So it can be a revenue account if you would say write up reserve. Something like revaluation, write-ups and revaluations normally into same category. Let's say we bought a land. Okay, now the market value of the land has increased. Let's assume. So market value of the land has increased compared to the previous year. So if you want to write down, if you want to add that value that is added, so you can add it as a write-up value. Right, if the land you bought for 1 lakh last year, so now the current value of the land is 1,50,000 according to the market price. So 50,000 is a increase in the value, right? So that you can revaluate the asset, or you can normally write up the asset automatically. Sometimes this happens because of the lack of supply in the market. The asset that you hold might get a popularity or demand in the market, so which would eventually increase its value. So in that case, you can write up the value of the asset to represent your asset value to a bigger number, or to reevaluate your fixed asset. Or you can also write down the asset of the value if you want to. So in this case, what happens is you will get the same kind of entry in the write down. So normally write down will be like this. Fixed asset account will be credited, means reduced. Write down reserve will come into. Normally there won't be write down reserve. Write up or write down reserve will be one account only. You can maintain single account. Write up reserve or write down reserve, both of them can maintain a single account. Like,
so it is like revaluation.
Yeah, kind of revaluation only. Both are same. Revaluation, write up, write downs are same, but different countries have different names and procedures. Okay, revaluation is also same. You know revaluation, right?
Yes.
Revaluation also, you can either increase the asset value or decrease the asset value according to the current market value of the asset, if you want to make any adjustments to the existing value of the asset. Okay, so in that case, normally what happens is fixed asset value will be either increased or decreased. Suppose let's say that value of the asset is increasing for 1500. Credit account will be revaluation reserve account will be credited. Suppose if the asset value is decreasing, fixed asset value will be credited, revaluation reserve will be debited. So that's all, which will add up the value or decrease the value according to the market revaluation of the fixed asset. That whatever you feel to do, that will occur automatically according to what you, in which way you want to revaluate it, upward revaluation or downward revaluation. Clear?
Yes, sir.
Anybody else? Seshu, Naveen, Sushila, is this entries clear for all of you?
No, clear to me.
Yes, bro.
Okay, perfect then. Then see, we now got an idea about what kind of asset, what kind of entries are posted into the fixed asset. Whenever we are doing any entries with the fixed asset, what kind of accounts should be get affected. So accordingly, we have to configure the posting profiles for every situation or for every transaction. Which account has to be affected, we have to configure in the posting profile of the fixed assets. Okay, so for regarding sales and scrap, we'll discuss it in the end of the fixed asset module, how the sale entries for fixed asset and scrap entries for fixed asset will be posted. So for now, we will discuss about the normal configuration of the posting profile. So it's here in fixed assets, fixed asset posting profile here. In the fixed asset posting profile, you can create a fixed asset posting profile as general. Normally, you don't have different posting profiles here. We only have one posting profile, general posting profile. Okay. Then here I can see here ledger accounts for acquisition, acquisition adjustment, depreciation, depreciation adjustment, revaluation, write up, write downs, and for everything, you can create the main accounts and assign it here. So for the acquisition, you can give account. So add it here. So for which book? For Companies Act book or for Tax Act book? You have to give two different. So Companies Act book for acquisition of. So all the groups, or do you want to give different accounts for different groups? Normally they will give different accounts for different groups. Or you can also use table option. Means you can select single fixed asset, but we did not create fixed assets right yet. So we can't select a single fixed asset. Most common selection is according to group, they will give different accounts. So account relation vehicle. So for vehicle group, for Companies Act book, whenever I do any acquisition transaction for any vehicle or any asset that is associated to the vehicle group, I should get main accounts and offset accounts from this place. So main account I can create as a fixed asset account, or I can create as vehicle asset account. So I'll quickly create one. I'll create all the accounts at a time. Let me see. So main account, I'll take it as 1,60,000. Vehicle asset, or I can just give it as fixed asset vehicle. Okay, then it is an asset account, right? So I'll just keep it as an asset, save it. Then I'll create another one. So for depreciation, so depreciation is 5 series, right? Expense. So I can see the expenses accounts here. I'll go for the expense account, 5,60,000. Okay. Depreciation expense, which is a expense account, 5,60,000 I created. Then I'll create accumulated depreciation. So I'll create it under the asset account itself. For 1,70,000 I'll create it. Accumulated depreciation as an asset account. So you can create it as a liability also, doesn't matter. So accumulated depreciation I just created as an asset account. Then I'll create for acquisition adjustments, we have the same asset account. Okay, for revaluations and write up and write downs, I'll create one. So I'll create this revaluation reserve account, which is a profit and loss account. I'll create. It has 6 series, 6,60,000 revaluation reserve. It's profit and loss itself. Okay, I'll create one more, 6,70,000 write up or write down reserve account, which is a same profit and loss account. It can be of any nature. So I created these accounts. Then I'll just go back. See here, when I'm doing the acquisition entry, what is my main account or what should be my debit account? So I'll normally give my debit account here. So what is my main account or debit account? It is the fixed asset account. So what is the fixed asset account here for the vehicles group? So it is vehicles account that I've created. Show all. So it's not vehicles account, 1,60,000, right? So this account, fixed asset vehicle. So I'm giving this account. Offset account it can be a cash account, can be retained earnings account, can be vendor account, depending upon the way that you are acquiring the fixed asset. We have multiple ways for acquiring a fixed asset. So offset account obviously vary from one account to other. So it is not a standard or same account all the time. So I'm not giving any offset account because I'll give it in the journal itself directly. I'm not giving any offset account. So coming to Tax Act. So again, I'll give it group wise for the same group of vehicles. I can give the same account for Tax Act, also same account, right? Fixed asset vehicle account. Here I can give in this way. So I'm going for another one like acquisition adjustment. For acquisition adjustment, I'll add one, select the same Companies Act book, group wise, vehicles group. So for acquisition adjustment also, it will either increase the asset value or decrease the asset value. Mostly it will increase the asset value if we do upward acquisition adjustment. So for that also it is same account, 1,60,000 account or fixed asset vehicles account. This one. So we have seen, right, acquisition adjustment entry here. Fixed asset account will be the main account and the offset account can be varied depending upon the situation. So I'm not selecting any offset account, I'm leaving it. I can select it while I was creating the journal or while I would create a journal, I can select that account. Vehicle, the same account here, this one. Then we'll go for the main important one, depreciation here. Depreciation, for depreciation, I'll select the same book, Companies Act book, go to group, account relation, vehicles group. So what is the main account and offset account for depreciation, guys? What is the main account?
Main account is depreciation account.
Now, see, main account represents here what account will be representing the asset account. So what account will be behind the asset account?
Accumulated depreciation account.
So,
Accumulated.
so normally for acquisition entries, what account will be behind the asset account? Fixed asset account will be behind the asset account. For vehicles, it will be vehicles, fixed asset vehicles will be behind the asset account. But while I was depreciating, what will be the main account that is representing the fixed asset? That is accumulated depreciation account. So that is why I'll select that one here. Accumulated depreciation. This one, accumulated depreciation, and offset account will be depreciation expense, right? So if the asset is, if the accumulated depreciation is credited, offset account will be debited. So the offset account will be depreciation expense account. So we have two depreciation expense account. I'll select this one, 5,60,000. Why I have two? I think we have created it earlier itself. So that's okay. I'll select this account, 5,60,000, which we have created for our example. So same for Tax Act book again. Go to group, same vehicle, and select the 1,70,000 account. Some people will create depreciation account, accumulated depreciation vehicles, depreciation expense vehicles separately. And for furniture and fixtures, they'll create separate accounts, accumulated depreciation furniture and fixtures, accumulated depreciation expense furniture and fixtures separately. Depending upon each group, they will create multiple accounts, like 5 to 6 accounts according to each group they'll create. Okay, I'll give the same account here, 5,60,000 depreciation expense account. So this is all, guys. Here I can go depreciation like this. Suppose if I want to give the, sorry, not here. If I want to give another one, if I want to give it for depreciation adjustment. Depreciation adjustment is nothing but if you want to make any adjustments in the posted depreciation, like if you want to reduce the posted depreciation, or if you want to add anything to the depreciation or increase the depreciation. Suppose depreciation was posted for 1,000, and if you want to add another 50, so you can make a depreciation adjustment. Okay, for that case, you can also give accounts related to that, like single group, vehicles group. Again, the same account you will get for depreciation and depreciation adjustment. It will be the same accounts. Accumulated depreciation account here and the depreciation expense account here. Again, Tax Act book, I can select group, vehicles, so the same account, copy it and paste it here, and the same account, copy it and paste it here. Perfect. If I want to give it for furniture and fixtures, then what I have to do?
We have to select account relation as furniture and fixtures.
Again, I have to click on add. Again, I have to select Companies Act book. So in the Companies Act book, I have to select group. Again, I have to select here as another group, furniture and fixtures. In the same way, for each group, we have to give all the accounts, like for Companies Act, Tax Act. For vehicles group, this is Companies Act, Tax Act for furniture and fixtures, Companies and Tax Act for plant and machinery. You have to give for all the groups relation. Again, I can change this one. So if you go back to acquisition, you can see for acquisition or this account that you have given. For acquisition adjustment, the same accounts. For depreciation, these are the accounts. Main account as accumulated depreciation, offset is depreciation expense. Coming to depreciation adjustment, you have this accounts. Then you can also add, sorry, not here. You can add for revaluation. Here you have revaluation. You can add one for revaluation for Companies Act, group, vehicles group. Main account, you can select the same fixed asset account. That is the one that represents the fixed asset, right? Offset account will be the revaluation reserve account that you have created. This one. Tax Act also you can give the same group. Vehicles, the same. See, when you understand the entries properly, then only you can understand what accounts has to be configured in this situation. Without having proper idea on the entries, you can't create this. So write-up adjustment also will be the same. Account relation is vehicles. For write-up adjustment also it will be the same asset account, like 1,60,000. And for offset account we have created one, right? This one, write-up and write-down reserve. I'll select that account. So again, for same Tax Act, group, vehicles. So it's a task to be done. It's a very big task to configure the fixed asset posting profiles. Normally it's very key and important. If you wrongly configure any account, then you will see the wrong entries, which would affect your books of accounts. Okay, you have to be very clear about what will be the financial impact or the financial entries, and accordingly you have to configure the accounts. Oh, sorry, not here. In the same way for write down adjustment also I can give here something. Tax Act book, group, vehicle, the same fixed asset account. Offset account as the write-up reserve account. This one. For Companies Act also I'll give the same. Group, vehicles. In the way that we are configuring for vehicles, we have to also configure for the furniture and fixtures if you want to acquire any furniture and fixtures asset. So that we will do tomorrow. Again, I'll just show you, repeatedly show you how for furniture and fixtures we'll configure the same kind of accounts tomorrow. In the fixed asset posting profile, we have two levels, one for the main transactions, another one here for disposals. When you are making any sale or scrap of fixed asset, there will be some entries that will get reversed. So that will be that we can configure here, that we will discuss at the end. When we arrive at that point of sale of fixed asset, we'll discuss it then. So we are only discussing about the part of a posting profile where you can give asset accounts for different transaction type, or the major transaction that you do, like acquisition adjustment, depreciation adjustment, revaluation, write up and write down, we have given them. Other than that, we also have disposal, sale, scrap. Eventually we'll configure them at the time of sale and scrap. We have provision for reserve, transfer from reserve, extraordinary depreciation accounts in case if you are running in extraordinary depreciation. Then special depreciation allowance account. This is one of the feature we have normally followed in US. Special depreciation allowances for not to calculate depreciation on fixed assets. So these are not compulsory, they are optional. I don't see any client using these provisions and allowances accounts normally, but you can configure them if you want to. So this is how. So all that you have to understand is these entries that we have created. I'll just copy these entries until here and just post it here. So if we go through these entries, make it clear, and if you know the entries clearly, then you will get an idea about which accounts has to be configured in which place. Normally in the main account place, that particular main account that represents the asset account will be selected. May it be the fixed asset account or the accumulated depreciation account will be in the main account. Offset account, for the acquisitions it will vary, so I'm not selecting any so that we can select it in the journal itself directly. But for depreciation, when you run a depreciation for a fixed asset, automatically this will come into place. So behind the main account it will be appeared, and behind the offset account it will appear. So the main account, normally the asset account only will show up in the fixed asset journal. It will only show the asset account, but behind the asset account this account will be there, accumulated depreciation account, when we are posting depreciation, and offset account will be automatically taken as depreciation expense account. We can see that while we do some transactions, so I can show you. Tomorrow we'll come back to the same posting profile, configure the main accounts for the F&F, I mean the furniture and fixtures, and we will create some fixed assets in the Dynamics. So there are some options in the fixed asset creation as well in the fixed asset master. We'll discuss about those details as well, and after creating fixed asset we'll acquire the fixed assets. Okay, tomorrow we'll create fixed assets and try to acquire them, and I'll show you different ways of acquiring a fixed asset as well that we will discuss tomorrow. So that would be all for today. So 1 hour and 9 minutes.